All right, the next thing we want to talk about is credit. And so this isn't something that we'll necessarily talk about with all clients, but there may be some clients that are working towards building or improving their credit, or some clients that are working towards repairing their credit. So let's just talk a little bit about what makes up a credit score. The first thing is payment history. One of the things that we can always advise is to pay on time, right? Paying on time is extremely important to the credit score. In addition to paying on time, we also want to keep our balance as close to zero as possible. So we want to pay on time. We want to pay as much as possible so that our balances are as close to zero as possible. Because the next most important factor is the amounts owed. The lower the amounts owed on credit, the better the credit score. So payment history and amounts owed make up the lion's share of an individual's credit score. And so managing these two things well is going to be what makes the biggest difference in either, again, building or repairing credit for someone that has that need. Now, the next three things that we want to look at are length of credit history, new credit, and types of credit. Now, lengths of credit history, this is going to be something that just evolves over time, right? The longer that a client's used credit, the longer their history will be, and the more benefit that they'll get from having that longer credit history. Okay, now one of the questions that you oftentimes get asked was, well, I have a credit card and I paid it off. Is it going to hurt my credit score if I close it because it'll reduce the length of my credit history? And the answer to that is, well, if you can't control your spending with this open account, then it's better for you to close it because you'll always be able to make your payments on time and or keep your amounts owed lower. And so you'll benefit more from closing it than having a longer length of history. Now, if you can avoid overspending while leaving the account open, then obviously then it's going to be most beneficial to keep that line open, but not at the detriment of these other two factors. So something to think about with regards to that issue. The other thing that we oftentimes look at, or that is a factor in the credit score, is new credit. And so one of the things that we can coach our clients on is anytime you take out new credit, it should be planned, right? The example that I like to give in class is if you go to check out at Target and they say, would you like to save 10% by applying for a Target credit card today? And a lot of people are like, well, yeah, sure. Saving 10% sounds amazing. So let's do that. Or for a client situation in a more sophisticated financial situation, it might be I was driving around today and I saw a car that I really liked. I couldn't afford to pay cash for it. If I did, I knew it would compromise my other financial planning goals. And so I decided to take out a loan and buy the car. Well, that purchase wasn't planned and the credit wasn't planned, right? And so we don't want to take out new credit unless it's planned, because oftentimes that credit is going to be detrimental to our overall progress towards our final goals. Okay, so we only want to have new credit when it's planned. Every time a client or an individual takes out new credit, it impacts the credit score in a negative way. Now, albeit a small impact, but it still does have an impact. And then types of credit, very similar to length of history. As an individual is using credit for longer periods of time, their credit portfolio becomes more diverse, right? They may start out with a student loan and then get a credit card and then a car loan and then a mortgage and then whatever, right? But it takes time to be exposed to those different credit types. Well, the credit score rewards a diverse credit portfolio because when these other things are being managed well, a diverse credit portfolio says that, hey, listen, this individual really understands the impacts of different types of credit, and they've proven that they can use different types of credit well over time. So credit scores are really important, right? And the first bullet point that we see here is oftentimes the reason that we associate credit, or this is where we associate the importance of credit scores, right? Is credit scores can impact credit availability, and the cost of credit. In other words, credit scores can impact an individual's ability to get a loan and the interest rate on that loan. Okay, so we know that. And the better our credit, the more likely it is we'll qualify for loans that are productive to reaching financial goals, and the lower the cost of those loans. And so really, really important to manage credit from that perspective. Things that we oftentimes less associate with credits scores are insurance rates and even the ability to secure or progress professionally, secure a job or progress professionally. So insurance rates, been some interesting studies that show that credit scores are the biggest predictor of the likelihood of filing an insurance claim. And so insurance claims are costly to insurance companies. And so low credit scores, more likely to file an insurance claim, higher rates. And so we don't want to be impacted financially by driving up the cost of insurance from having lower credit scores. And then maybe not necessarily a financial planning issue, but something that's worth noting is that a lot of employers oftentimes look at credit as a risk factor as well. If insurance companies are using it as a high predictor of risk for individuals, employers have basically latched onto that and said we should probably do the same and use that as a predictor of risk when bringing on new employees. And so again, we think about credit as potentially costly here, it can be extremely costly in this third bullet point, right? If it means the difference between getting or not getting a job or getting or not getting a promotion. Okay. So there's three different things that we need to be aware of when it comes to credit. The first one is credit bureaus. Credit bureaus are the organizations that collect all information that goes on credit reports. There's three different bureaus: Equifax, Experian, and TransUnion. Okay, they're all independent of one another. They all collect the same information, theoretically speaking, and they use that information to create credit reports. Okay, and credit reports have a bunch of different information on them, right? What is an individual's past with using credits? So what accounts have they opened? What was their payment history with those accounts? Have they paid them off? And the list goes on and on and on, right? What credit reports do not contain is the credit score. The score is reported separate from the credit report, okay? Now, credit scores basically take the information on the credit report and they create an apples to apples comparison of credit worthiness across individuals, right? And they use the criteria that we talked about before to produce that score. The higher the score, the better. Okay. Now, you can get access to your credit reports for free every year. You can get access to a credit report from each one of these credit bureaus for free. The way to do that is annualcreditreport.com. Now, it sounds like a scam, right? You're thinking this should be .gov or something .org. Annualcreditreport.com was established by the government as part of the Truth in Lending Act that was passed in either 2009 or 2010 so that people had more transparency into borrowing decisions. And part of that transparency is access to their own credit reports. Okay, so when you go into annualcreditreport.com, you don't have to input a credit card number. You don't have to sign up for a trial subscription. It is truly free and secure. But they'll go in and they'll ask you for your information to verify that you are who you say you are. And then you can select the bureau that you want to receive a report from, and you can run that report. Some financial planning firms use that. Some financial planning firms have paid services that allow them to pull credit reports when necessary to evaluate where a client's at in relation to this financial planning matter. But very helpful to know that that's available. Now, information that's on a credit report, right? I talked a lot about credit history earlier. In some cases, there may also be employment history or criminal convictions and judgments, right? This is something that will automatically get reported to the credit report if it exists. Employment history is up to the employer with regards to whether or not they report an employee's record to the bureau, right? So some employers report their hires to credit reporting bureaus and others don't. And then all credit reports have personal demographic information, right? Name, age, social security number, addresses of the individual that the report is for. And then all reports have 2 years worth of inquiries, right? Who is pulling the credit information for the individual is being shown on the report as well. Other factors that determine credit worthiness that are not included on the report are an individual or household's annual income, time at their current job, time at their current residence. All of these things are measures of stability. And then it might also, other factors that a bank might also look at are what is the value of assets, right? How many other accounts are in play in relation to the account that the person is applying for, right? So there's lots of things that are going to impact credit worthiness that never show up on the report that a lender will look at when making lending decisions, okay? So it's important to really consider these two things in whole, right? We don't just want to look at one without considering the other, because we know that both are going to be important to lending decisions and determinations of creditworthiness over time. Now, another important thing to note is that a lot of credit reports have misinformation on them, right? So when you go back to here, we want to make sure that when we pull our reports, that the information reported is correct. Because if a lot of reports have errors or inconsistencies on them, we would want to correct those things with the report. And so that's a relatively easy process to go through, but making sure that reports are accurate can be very important, because when it comes to requesting to borrow money or applying for insurance or even applying for jobs, we don't want incorrect or old information to impact those decisions in any way, form, or fashion. All right, so that's a brief overview of credit, and it's going to be a good segue into talking about debt, right? How can we use debt as a tool? How can we manage the debt portfolio of a client to make sure that debts are helping us make progress towards our goals, not slowing us down?